Hello students, welcome all to E-Pathashala. This is Professor Chellam, working for Sita Lakshmi Ramaswamy College, Tamil Nadu. Today the topic you have chosen is Management of Financial Resources under Quantity Food Production. What is finance? Finance is a critical term that involves lot of risks and challenges. Managing the finance in a food service establishment becomes a critical area of business that deals with the effective management of money and money worth dealings of an establishment. In olden days, financial management has been understood as simply recording all the expenses and incomes with paper and pencil. But today, the concept is totally changed into analysis of statements and financial records and to take prudent decision for the growth and welfare of the organizations. Hence, the modern financial management is dealt under two distinguished procedures called financial accounting and management accounting. So children, after learning this chapter, you will be able to understand the key aspects of accounting, also to identify the principles of accounting, and you can get introduced with the basic financial statements. Finally, the role and importance of budgeting control in quantity food management. Now, let's move on to the detailed lecture on financial management. It is very important to know the uses of financial statements before you learn in detail about financial management. So, who are all in link with financial dealings or who are all using the financial aspects in their regular day-to-day life? There are 7 broad groups of users who were identified in the food service establishments as users of financial statements. They are the owners, the directors, the managers, creditors, employees, government agencies, and financial analysts. If I wish to see their specified role, I can show you a slide here. Owners always keep monitoring their investment status of the business as they are the investors. Board of directors, they are elected people to supervise the business transactions and to look after decision making of the institution. Managers, they evaluate the financial operations then and there and they take prudent decisions. Creditors, they are much bothered about the payment obligations, lending and crediting monetary benefits to the establishment. Employees, always very curious about knowing the financial position of the establishment, whether it's going to help them to meet all the wages and bonuses what they are going to get. Government agencies, they are more concerned about the financial position of the establishment for the taxation purpose. Financial analysts, they are outsiders, but they keenly watch the financial position of the establishment in order to fulfill his client's wish. In a non-profit making establishment, usually public is also viewed as owner in the interest of they are as part of the organization. A client can be categorized as an additional user and he also ensures the monetary status of the organization. Now, it is time for us to learn the important components of financial resources. The following are the essential components of food service system. Here, each and every aspect of finance worth aspects is treated as components as they contribute their distinct role. In a food service establishment, money is treated as a very important component as they are the input. Financial accounts are the real output. Financial data will be the memory function. Budget will be the controlling unit, and financial statements and interpretations are the final product of financial management. All these components works hand in hand and gets interlinked each other and working as a system of management. So, what are the key aspects of accounting? There are 4 basic components formulate the financial management principles. They are auditing, cost accounting, financial accounting, and management accounting. What is auditing? Auditing is an area of accounting that deals with the review of accounting statements and records. It's an examination externally done by the government sector to judge the fairness and reliability of the agents or the organization. Then cost accounting. What is cost accounting? It is nothing but the process of determining the cost and control of cost. In a food service establishment, cost accounting principle takes up a special concern because it deals with the cost of food production and distribution also. Then financial accounting. It is the real statement of financial position of an establishment that pass on the relevant information to the outsiders, such as insurance companies, tax department, and it includes all the financial statements that as balance sheet and income statement. Managerial accounting. It is the history of financial status of an organization. The data that is offered by the managerial accounting helps the management for day-to-day operations or planning for future. It also helps to analyze the alternative course of actions. Budgeting control is one of the major operational features of a managerial accounting. So these are all the important components of financial management. Now we will see some interesting scope of financial management. Financial management intensively supports decision making of an organization for policies and resources that are some superior elements that are present in the management that involves a lot of risk and challenges. Financial decision making can be done under three major areas. They are investment decisions, financing decisions, operational decisions. Investment decisions. Decisions on capital investment could be done through optimum utilization of financial resource. Assets and liabilities could be well managed by using investment decisions. Change in taxation policies of government can make investor to rise the investment pattern. A caterer can take investment decisions on the liquid cash what he has got in hand by investing them on modernized equipments, infrastructure development, facilities expansion, and portion of the business, expansion of the business for better possible ways. In this situation, a caterer must see the financial statement of the organization and can take prudent decision. By applying financial decisions, a catering organization take prudent decision in all financial areas of management. There are two ways by which the finance could be generator for the establishment. One is taking loans or borrowing money, and the other one is shareholders fund. It is easy to generate funds by borrowing money, but it involves lot of financial risks of insolvency in terms of non-payment. Hence, it is necessary to think twice before shareholders. And here in the financial statement, it also helps to choose the right options of fund generation too. Operational decisions. Operation decision is nothing but the decisions that are taken for doing effective operations. By utilizing the existing resources, it can be done. Decisions regarding the sale, overhead charges, employee expenses, meal charges, including both direct and indirect charges, are to be considered under operational decisions. Decisions pertaining to the selling price of the food items are called disposition decision. Generally, percentage of profit is to be fixed. The mode of payment by the customer, disposition decision, options for the credit of sale, and all these work under operational features, and the decisions regarding these are called disposition decision. So the disposition decision is an important area of operational decision that has to be given priority in financial management is concerned. Now let's see the principles of accounting. The basic understanding of principles of accountancy would help the users of financial resources understand the interpretations properly. The commonly adopted principles of accountancy by food service establishments are discussed here. Business entity concept. Business is a separate entity. It does not involve any individual and requirement. So it has to be treated as an union of people who are working in the organization and owing. The fundamental equation. Business has to be considered as a fundamental equation. The relationship between the assets, liabilities, owner's equity are called fundamental equations. There must be a direct proportion of all these aspects for healthy financial management. And next one is going green concept. The company's assets to be treated as a long-term investment. So it is very important to understand the financial position of the organization, and actions have to be taken accordingly. Money here is treated as a unit of measure. To obtain a perfect financial data carefully, it is very important to treat money as a unit of measure, because every financial transaction must be documented then and there. Here, money is treated in financial terms as unit of measuring the transactions what you are doing in your organization. Cost principle. Cost principle involves recording all the transactions in local values. Cost is the value of money spent on goods and services in rupees and dollars. balancing revenues and expenses. The concept of matching revenues with all applicable expenses during the financial year is very important to avoid financial confusions during the tenure. For example, restaurant's manager can purchase food in one financial year that can be expended in the next financial year also, but the sales documents would be done with the previous year's expenses also. Unless it is prepared, it is impossible to get the balance sheet done for the second financial year's statement. This matching concept must have to be kept in mind while you treat financial functions properly. Then depreciation. It is another important principle of financial management. It is a very essential and accurate accounting is very important in a systemic manner. It has to be done in a financial organization. A number of methods are used to calculate the depreciation of an organization by using a special method called straight line method. This method calculates the depreciation of the establishment over a long period of time as an asset. A simple formula is used in this kind is called, using a straight line method is called, cost of asset is actually minus from the salvage value, which is divided by the years of useful life of that particular equipment. Then the next principle is consistency principle. It is a method of choosing an accounting system by an organization for the recommended period of time to make the financial data comparable. Then the next principle is materiality principle. It is the principle of accounting the events and informations into account. So these are the basic principles that have to be kept in mind by the financial advisor of the organization, that is the manager, to successfully run the organization with a financial soundness. Now let us move on to the basic financial statements. Unless otherwise you know the basic financial statements, it is very difficult to understand the financial management of an organization is concerned. The primary financial statements used by an organization are balance sheet and income statement. Both the statements provide adequate information regarding the accounts. What is a balance sheet? A balance sheet is a statement of financial position of an organization that publish the list of assets, liabilities, and the equity which is owned by the owners at the specific date in a particular period of time. That is the financial year. This is designed in such a way by adopting the basic principles of account after regarding the entry of journal and ledger. What is asset? Asset is the actual component of the financial statement. It has to be given much priority while recording it in all the statements. The first part of the balance sheet is filled by the list of assets that are copied from the current account actually. Generally, assets are classified into three as current asset, fixed asset, general asset. Current asset include the cash in hand, accounts receivable, inventory, prepaid expenses, entrance fees, land, etc. The fixed assets are assets that are actually fixed for long period of time, like buildings, lands, furnitures, equipments and utensils that are categorized under fixed asset in a balance sheet. General asset are assets that are spent, or the money that are spent for general supplementary investments. Now let us move on to liabilities. Liabilities are the debts of the company. These are classified in a financial statement, that is in the form of current liability and long-term liability. What is current liability? Current liability is a debt that has to be paid within a period of time, short time. Whereas, for example, the current liability is payment of purchases of annual mortgage and occurred expenses based on purchase of all equipments and materials are concerned. Whereas long-term liabilities are actually done by the establishments, need not be paid within a stipulated period of time. Example of long-term liabilities are mortgages for building or land. Next one, owner's equity. It is the capital section of the balance sheet that represents the money value of the stock, earnings of the organization and the additions of capital. In profit-oriented organization, the ownership may be of three types: proprietorship, partnership and corporateship. Ownership may be of the single type, that is proprietorship. It is nothing but the single ownership. Partnership is nothing but multiple ownership, and corporateship is called as ownership done by the stakeholders. In a non-profit organization, the members may be the owners of establishment. Now let's move on to income statement. Income statement, it is the statement of profit and loss earned by the organization in the financial year. It is prepared once in a year in order to estimate the financial soundness of the establishment. In the statement, sales or revenues of food and beverage of the financial year are incorporated. Expenses such as administration, marketing, operational cost and energy cost are stated under this statement. Certain fixed expenses like taxes, insurances, interest and depreciation would also be informed in this column. With the help of income statement, the financial soundness of the organization can be easily judged for a particular period of time. Then the next aspect is tools for comparison and analysis. To analyze the financial position of the establishment, we have to choose certain tools. So, the financial manager must use variety of tools to analyze the efficiency of the financial data. Commonly used financial tools are ratio analysis tool, trend analysis tool, common size statements and break-even analysis tool. The results of analysis generally indicate the manager the financial compatibility of the organization. Let's now see what is called ratio analysis and how it's going to help you to analyze the financial position of the organization. This is a common method of analyzing the financial data in terms of relationship, facilities and understanding. It is expressed in several ways such as common ratio, nothing but the ratio between X and Y, the percentage of sale, the turnover, number of times the inventory is being turned in a month and per unit the sales per session. These analyses categorically help you to find out the liquidity, solvency, activity and profitability and all the operational features of an organization. Now let's move on to the trend analysis. Trend analysis is a comparison of results of an establishment over a long period of time. Here, a lot of changes that happens and it turns up the actual financial position of the organization in amounts. It is used to forecast the future revenue and also the level of activities. It is usually represented in the form of graph and will help the manager to understand the financial position over a period of time, maybe even for a period of few years. Finally, break-even analysis. It is one of an important tool to analyze the financial stability of the organization and it's a popular tool also. Break-even means no profit, no loss. That is, total expenses are equal to income. It helps to analyze the cost in three distinct ways, such as fixed cost, semi-fixed cost and variable cost. Fixed cost is the cost that does not get changed over the change in production. Example of fixed costs are rents, rates, taxes, insurance, etc. Variable cost is always changed by nature. Food cost or material cost always gets changed, so they are called variable cost. Some costs like labor and maintenance cost changed only during a heavy variation in production, they are called as semi-variable cost. So, break-even has to be analyzed by using the ratio and comparison between the fixed cost with the variable costs. It helps to assess the financial position and soundness of the establishment very well by using a simple technology. Now, budgeting. Budgeting has to be done by the financial organization as it is a very, very important tool of financial control. So, keep learning this area with more attention. What is a budget? Budget is a plan of future expenses in financial terms in order to control expenses and profit as per sale. This is also an important tool of financial management by which all the resources are controlled effectively. It is a tremendous process that involves planning, preparation, control, reporting and utilization. So what are the benefits of budget? Do we have any benefit of budget? Yes, we have lots of benefits by planning budget in an efficient way. Budget can forecast the future plan of an organization. Budget can control the operational resources. Budget can coordinate the objectives of management and also it is a tool for periodic examination. Then how come down to the types of budget now? Budget are classified into several types based on their behavior, duration and nature. The capital budget is a type of budget that focused on the assets of the organization, nothing but the capital investment of the organization such as budget that is spent for or allotted for equipments, shares, plants and infrastructure. These are called capital budget. Capital budget play a very major role in an organization too for the growth and development of the organization. Operational budget. The operational features of an establishment are allotted with some amount of money, which are called operational budget, such as sales, purchase, administration, maintenance of the establishment. The money that is spent on all these areas are called operational budgets. Master budget. This is a very important budget that shows the assets and liabilities of the establishment. The assets and liabilities that is owned by the establishment has also to be given priority in the budget planning. It is actually done by referring the previous records. Departmental budget. It is a type of budget which is prepared independently by an individual department of the establishment based on their needs and requirements. Maintenance and service of the establishment is actually focused here. Now, what is a fixed budget? Fixed budget is a budget that is, it remains fixed for a period of time. It cannot be changed. For example, rents, rates, administrations and advertisements are called fixed budgets. They cannot be changed. What are flexible budgets? This is a budget that focuses on the volume of sale and cost of sale. The budget of college and school canteens, hostels are all this type. It is something interesting to learn how to construct a budget, because to understand the construction principle of a budget only, we could able to plan an efficient budget. Planning budget must be done systematically and sequentially. Following are the steps involved in planning budgets for commercial organization. There are several steps that are involved in planning a budget. Step 1. Development of sales budget. The sales budget is constructed as the first step, and it is the plan or estimate of revenues expected by the organization, for which the past experiences should be examined well. Changes in prices, rates are also considered here. National and local indicators such as new companies, share market, changing trends are also to be calculated under this particular area. Seasonal variations and purchasing policy are also given priority while planning the first step of the budget. Step 2. Development of expenditure budget. Expenditure related to the estimated level of revenues to be incorporated in this step. Food, labor and operational expenses are to be clearly mentioned here. Labor budget is constructed with increments in salary and wages of the year. Anticipated changes in food costs must also be informed here. Menu changes, operational changes that may influence labor needs and also to be included here. Step 3. Development of cash budget. It is a detailed estimate of anticipated cash receipts and disbursements including the financial tenure. This will help the management in informing the cash inflow and outflow and the cash resources, mode of heavy payments, tax and insurances, clearances, and are all being planned ahead in this step itself. Step 4. The development of capital expenditure budget. The needed developments in the establishment such as expansions, improvements, replacements, purchases of land are to be included in this budget. So, extra care is needed in formulating this step to avoid unnecessary commitments in long terms. After reviewing the need for the change, this has to be done. The last step of the budget making is preparation of pro forma statement. It is a combination of sale and the expenditure along with the estimate of profit. It is a consolidated statement of annual requirement of the finance for the overall work of the establishment. After careful planning of all these steps, the budget has to be reviewed by an experts committee from the management and technical advisors. It has to be documented pakka for execution. Now, to sum up, effective management of financial resources is a crucial area for the success of an establishment. Hence, it is the duty of the manager to have a thorough knowledge and exposure on planning, constructing, executing, analyzing and controlling the essential procedures of financial management, and also to have a successful results in the outcome.